at 4.3%. Let's go right now to Steve Leisman in D.C.
The Federal Reserve keeping interest rates unchanged at 4.25% to 4.5%, but it makes a point of saying that uncertainty around the economic outlook has increased, and the Fed says it is attentive to risks on both sides of its mandate. In a move that we will be debating, it removed the statement saying that risks to its dual mandate are roughly in balance. That came out of the statement this time. On the Fed's projections, it boosted core inflation to 2.8% for 2025 from 2.5%, so 0.3 up. By the way, exactly mirroring the CNBC Fed survey. It kept 2026 at 2.2, and same for 2027 at 2%, suggesting the Fed either thinks it will control inflation through its policy or that any tariff issues will pass through. It did reduce its growth forecast all the way down to 1.7 for this year from 2.1%. and by 0.2% in 2026. So the Fed does see a weakening impulse coming to economic growth. However, in answer to the discussion you were just having, it really kept the unemployment outlook very much unchanged, only a 10th increase in the unemployment forecast. So now you're wondering what they do with rates. They kept the 2 rate cuts in place for 2025, but the dot plot is a touch more hawkish, and I will go over that in just a second. I want to tell you the news on the balance sheet, for which there is some. They reduced the runoff of treasuries down to $5 billion a monthly from $25 billion. They kept the mortgage-backed security runoff at $35 billion. Governor Waller, he dissented, very technical dissent actually. He agreed with the idea of not to change rates, but he did not want to change or reduce the balance sheet runoff. On the economy, they say it's expanding at a solid pace. They say unemployment has stabilized, but inflation remains somewhat elevated. Now, let me give you the hawkish tilt inside this dot plot here. 4 of the 19 officials wanted no rate cuts, compared to only 1 in the December forecast. 4 see only 1 cuts, and 9 see 2 cuts. What's gone is the kind of, I don't know what you'd call it, the dovish wing of the committee here, where there were 5 people who were looking for 75 basis points of cuts this year. Now there are only 2. So a kind of compression here, leaving the top where it was and some of the bottom coming up. A little bit more hawkish here, but the median still maintaining a forecast or an outlook, not a promise, but an outlook for 2 rate cuts this year. Guys, back to you.
So, Steve, I can't say, look, the market is interpreting this in a somewhat dovish manner. And for me, I'm going right to the balance sheet on this. This is super interesting. And I want to make sure that I kind of explain this clearly and that I understand it clearly. So in essence, the Federal Reserve just decided it's going to sell fewer Treasury bonds, right, from its balance sheet. As it's deciding...
Can I grammatically correct you, Kelly?
Well, yes, I'm oversimplifying.
Only for technical reasons. I don't want to be rude here.
Yeah.
But I do want to say the technical thing is the Fed will allow fewer treasuries to run off of its balance sheet. That is, to run off, mature, and not be replaced. They're not selling. If they were selling, the market would be freaking. But they're letting it run off, so the market's not freaking. Sorry for the interruption.
Well, I guess point being, and maybe one of our guests can step in. David Kelly, I'd be curious for your reaction on this, but if the Fed is slowing the runoff, on the margin, that's why I'm looking at bond yields falling right now. Is this welcome news for a Treasury market where every little bit that helps in terms of people keeping the treasuries that they have and not reducing their balance sheet more, as the Fed's doing here, does that really help on the margin with interest rates as we watch the 10-year moving to the downside?
Well, very marginally. This actually wasn't unexpected. The problem, they've got some multiple areas of uncertainty here, and one of them has to do with the debt ceiling. So they think there's going to be a debt ceiling agreement at some stage over the summer. When that happens, the Treasury is going to bounce up or increase its holdings of the Federal Reserve, which will cut reserves. It brings the idea of a problem in the Treasury market more, or in short-term interest rates more likely, and that's what they've been trying to avoid. They want to be sure that they don't have a repeat of what they had back in 2018, where they let reserves get down too low.
Yes.
Now they see a risk of that in the next few months, and that's why they're just backing off here. They just don't want to reduce that balance sheet too much and end up with a problem. So just trying to keep out of the way of trouble here in a very uncertain environment.
And David, I only want to harp on this because Steve just said there were some hawkish elements. So if people are wondering, well, why would that not translate to bond yields going up and so on and so forth? I mean, do you think that these moves on the balance sheet offset or mitigate that to some extent?
Maybe a little bit, but I think the truth is the economy, traders, consumers, businesses, we're all in wait-and-see mode here on what administration policies turn out to be in the end on tariffs, on government cutbacks, on immigration, and on fiscal policy for 2026. I think the one thing I would sort of take issue with here is I actually think economic growth could be slower than 1.7% this year, fourth quarter over fourth quarter. We're seeing a good deal of weakness in the first quarter numbers, which isn't really reflected in their statement. So that's the one place I'd be a little bit different from the Fed on here. But I don't blame them for trying to be cautious here because they really have to wait to see what the other side of Washington does.
Yeah, and Steph, let's go back to this idea of the grammatical technical correction, right? The runoff, not the sell. And Steve, you jump in. But Steph, this seems to be maybe a bigger deal than the headlines might suggest. And I'm saying that because our friend Jeff Kilberg notes this is kind of a mini QE, quantitative easing injection. At least it appears that to him. Most of our viewers and listeners probably don't care that much about what the Federal Reserve does. They simply want their own borrowing costs, mortgage rates, auto rates, credit card rates, whatever it may be, to come down as well. How do you read this running off, not selling of treasuries?
Yeah, and that's been the case throughout, most of this QT period. Now they're just slowing down the pace of that, which makes sense, right? As David highlighted, there's concern around the debt ceiling that could create a lot of volatility within reserves. They're just trying to get ahead of it. This was a fairly modest move, and it was hinted in the minutes. So while this is slightly, a slight surprise, it was not overly surprising for the market, but this is the one difference versus what forecasters had effectively priced in, which was the change in growth, change in inflation, and expectation that they could stay pat on rates at this point because we don't really know the full effect of policy. April 2nd is going to be a really telling deadline in terms of what Trump's going to do from a tariff perspective.
Yeah, sorry, Jim. Let's go very quickly through just kind of the people who are just joining us here. Oh, my gosh, the Federal Reserve, they jump in. Here's, I think, how we're reading this, and again, Steve Leisman, please jump in if any of this is not correct. By the way, markets there are not moving or moving slightly higher. Maybe on this news we shall see. The Fed sees the economy expanding, maybe 2 rate cuts seen this year. No real change in the job market the rest of the year, maybe a slight. I think Steve Leisman said 0.1% drop in the jobless rate so far this year. Inflation maybe mildly higher as well. So, Jim, how do you read what the Federal Reserve just did?
I think this is very non-committal. The Fed is kicking the tires on the economy. Look, we have a couple of things in front of us, and I think it's very important to respect the timeline. We've got reciprocal tariffs coming up on April 2nd. We don't really know how that's going to go, but it's in front of us. Then you have first quarter earnings results that are going to come out. CEOs are not going to sing a positive tune about the first quarter, right? You're likely to see some basically some bad news from some of the CEOs, or at least talking that way. The next Fed meeting is May 7th, and I think that tees us up for a rate cut at the June 18th Fed meeting. So essentially, this is the first time the Fed is trying to make a decision as financial conditions are tightening, meaning that credit spreads are widening and the equity market has just gone through a 10% drawdown. So effectively, this is the first time the Fed is trying to decide, as markets are now starting to soften and weaken, what they ought to do. And in the past, you had a stronger equity market, tight credit spreads, and the Fed was trying to convince you that cutting interest rates was the right thing to do. Now, the markets are kind of siding that way, but they're not 100% sure how this is all going to play out. April data, the events of April, I can't underscore this enough, are going to be extremely important, and I think the tone is going to be changed by May 7th at the next meeting.
Steve, we know that the market's first interpretation is often not its final one. Going back as we digest this, what kind of explain to us the hawkish element you see a little bit here in the statement and in the dots?
Okay, I'll go back to my notes here. It's a very technical thing. I wish I had a graphic I could put up. Maybe they have it up right there. Okay, so here's what happened. There's 4 now with no cuts for this year. That had been only, I want to double check what I'm saying here, had been only 2, okay? And then you see there's 2 with 3 cuts. There had been 5 with 3 cuts. So a compression towards the middle. Guys, I want to explain how maybe I look at this whole statement. I don't see the balance sheet as that big a deal. The bond market may get some help from that. To me, this is a bit like the Fed sending up flare or an SOS and saying, we don't know what's going to happen. They reduced the growth rate pretty sharply. They raised the inflation rate pretty sharply and kept the outlook for rates pretty much unchanged. But more importantly to me is it removed that statement in the from the last statement that said, we think risks are roughly in balance. That's gone. I don't think they know where risks are going to go. And I think what they're doing, I think it was Jim who said it earlier, playing for time is where they're at right now because of the uncertainty. Look, they took this statement that said uncertainty has increased and put it up in like the second paragraph of the statement here. So this is almost waving a white flag on the outlook saying we surrender.
Well, I guess, and this is great stuff, and I threw both this statement, Kelly, and the last statement into ChatGPT because I wanted to see what it filtered out, and basically Steve Leisman is ChatGPT because the two came to the exact same conclusion.
Sorry,
and Steve doesn't require nearly as much energy. David, Kelly, what's interesting about...
You don't know how much energy I require, Brian.
Well, today I know you might need a few extra caffeinated coffees. David, but here's the reality, and I think to waving the white flag point, April 2nd are when these new tariffs are supposed to kick in. They may not. They could kick in before. They could kick in never. They could kick in later. We don't know how much. I'm not saying this statement doesn't matter, but how much do you think the Federal Reserve is like everybody else, just kind of waiting and seeing what this administration does? Because how do they make any real policy moves when we don't actually know what's going to happen?
Exactly. 2 days after the election, Jay Powell said, we don't guess, we don't speculate, and we don't assume. But you can't make monetary policy unless you do one of those things. And so eventually it's going to have to make a monetary policy move one way or the other. But I think it's not just the tariffs. The other part of it that's really important is how does the tax bill for 2026 evolve over the next month or two? If we get one big bill which involves a lot of fiscal stimulus in 2026, then the Fed's going to look at that and say, why should we deliver monetary ease if on the other side they're stimulating the economy also? And so they want to see that too. So I think it's a bit about tariffs, but it's also a lot to do with how Congress shapes this tax bill for 2026 and what that means for the outlook for 2026. And the Federal Reserve is signaling greater uncertainty, but they like everybody else just has to wait and see.
All right. Panel, thank you. We'll leave it there for the time being. We appreciate it. As the market moves back towards session highs, Dow's up 235 points. On that note, let's get down to Mike Santoli at the New York Stock Exchange. Mike, and what's your take?
Yeah, Kelly, I think the reason the market, initially is able to have some measure of comfort with this outlook, to me, is in the raising of the inflation projection, PCE inflation to 2.8, and not reducing the median number of cuts. That, to me, suggests some level of tolerance for inflation being sticky. They still think policy is somewhat restrictive. They still think that disinflation is the reason that they would be normalizing rates lower from here. And they don't see a reason collectively at this point to change anything. Now, none of those positions is held with high conviction. And I think as everybody's been saying, they're essentially just going to defer to the next several weeks worth of facts and developments before we decide on that. I think it leaves the market in a position of probably rooting for the economy to stay in there. You realize that the Fed ultimately would kick in if we got weakness, but good news on the economy should be good news for the markets because, you're not really wishing for things to erode quickly from here, I don't think, if you want earnings estimates to hold up.
Let's go down to Chicago, and a man I just saw in person, by the way, which is great, Rick Santelli. Okay, I need your help, Rick, because I'm very confused. We're starting to see headlines crossing from other news organizations. Financial Times saying Federal Reserve sharply cuts U.S. growth forecast. Okay, maybe, but the first line of their statement is recent indicators suggest the economic activity has continued to expand at a solid pace. I'm trying to figure out where some of these headlines are coming from. Are you seeing something different?
Yeah, most of the people I talk to that are traders or with large institutions, hedge funds, they don't really pay as much attention to these flashes as you're pointing out. As a matter of fact, with all this talk about uncertainty, here's what many people I talk to jokingly say. When we were pre-uncertain times, was the track record of the crystal ball of the Fed and their dot plots very accurate? No, it wasn't accurate pre-uncertainty. I don't suspect it's going to be any more accurate during uncertainty. Here's what many traders are talking about even before any of this happened. Okay, we're talking about any changes more or less, and that really is it. More, less. Okay, and I'll tell you what I mean. Downshift, less growth, but not recessionary. Less labor strength, but not recessionary. Less inflation progress, paying more attention now than they did, and less easing based on just general notions that they're going to remain pretty aloof because they really don't know what to do, and less QT. And all of those things I discussed with many of my sources long before this statement or the Fed meeting. These were from yesterday or the day before. And the reason I bring them up is that I think when we talk about balance sheet, first of all, that was completely built in. Actually, many expected that we wouldn't just get less QT, that we would actually end QT or do more quantitative easing. So I don't see much movement actually from that headline. But I think that when you look at it all together, what you see is exactly as our panel said, a Fed that doesn't want their fingerprints on the shit because they don't know what the future is, but they've never known what the future is. We just don't know how the globe is going to readjust to all the things that may come down the pipe. Maybe Liberation Day on April 2nd, we get no tariffs. But at the end of the day, keep two things in mind. Okay? That is, if the Fed doesn't do as much, short end is going to get sticky, and it has. Right now, twos are hovering right around unchanged. Matter of fact, most of the curves around unchanged. And the long end is going to be very disturbed that we're not going to get anywhere closer to the 2% target, and most likely this administration isn't going to make huge progress on deficits. So, if you had to summarize, once again, I think you're going to look for some curve steepening driven by long rates going higher.
Rick, when you say curve steepening, I remember those debates that we had about flattening being a bad thing. So is this moving in a more constructive direction here?
Well, I think it's a more constructive adjustment, in my opinion, because I think long rates divorcing themselves from some of the manipulative forces and being more susceptible to market forces is truly a good thing. And once again, I think that the equity markets now are showing you the true direction. Maybe there's not going to be any Fed put, so to speak, but don't kid yourself. The Fed pays very close attention to equities, and the more volatility they get in equities, the more uncertainty they're going to showcase in their statements.
Yep, that U word, Rick. Thank you very much, Rick Santelli. Let's welcome in Richard Clarida, the former Fed Vice Chair, Global Economic Advisor at PIMCO. All right, Rich, what's your take? Welcome.
Well, you know, I think there was a lot of focus on would the dots remain unchanged, and so they still show the two cuts, albeit with a little bit more disagreement. I would point out the downshift on the growth projection is basically to the pace of growth the Fed thinks is consistent with trend or potential growth. But yes, they are emphasizing the uncertainty, and I'd expect the chair to say that in a couple of minutes at the press conference. And then finally, I think there was some speculation based on the January minutes that they might end QT entirely today. So essentially, they're saying they're going to cut back the pace of the runoff, but still do some runoff. So all in, I think a pretty constructive meeting compared to some of the concerns going in.
Market seems to be most happy that despite their upward revision to their core inflation forecast, they upped it by 0.3 because of tariffs. But they didn't change the fact that they still could do two cuts, right? So you're kind of getting that best possible. They're looking past the tariff impact there.
I think you're 100% right. You know, there's been an ongoing debate in the press, online, and I'm sure probably at the Fed about the best way to think about the Trump tariffs, and consistently, what Chris Waller and Chair Powell and others have said, the first instance is to look through that as not inflationary, and I think today's signal from the dots is an indication that that's their baseline. They're going to be attuned and attentive to inflation, and if you look, they indicate that there is upside risk to inflation from this forecast. So I think that also explains some of the change in the language wording.
There's a firm out by a big mall called Fashion Island in Newport Beach, California. They manage trillions of dollars. They're called PIMCO. You might have heard about them, Richard. And PIMCO's job is not to react to the Fed as much as it is to anticipate what the Fed, or what more importantly, the bond markets may do. The bond market, as I pointed out at the top of the show, may be saying something different than our friends at the Federal Reserve are, because borrowing costs have actually gone up, not down, even as they're talking about cutting interest rates. Where does PIMCO see borrowing costs 6 months and 1 year from now?
We had a big move up in Treasury yields, in the anticipation of the election, and then after the election, the so-called Trump trade. So some of the move in yields really has not been so much about monetary policy as about, the fiscal outlook. We've consistently said we think we're going to be in a world of a steeper yield curve. I noted that on your conversation a moment ago. The 10-year Treasury yield has really been in a range of between 375 and 475, and that makes sense to us right now. The big question is, when and how rapidly will the Fed cut, and that's going to be very data dependent. So I hate to disappoint you with that.
But Rich, my point was, does it listen, I'm not discounting the Fed. They run the show.
Yeah.
I get it, okay? They're kind of like the referees, if you want to compare them to March Madness. But they're talking about cuts, and the bond market is going in the opposite direction. We have viewers and listeners that are thinking about buying a home, and they're waiting for rates to come down, and they hear, ooh, the Fed's going to cut, honey. Don't worry, we'll wait a couple of months, and mortgage rates will come down. Guess what? They've waited, and mortgage rates have gone up, not down, since the September 18th Fed rate cut, where they sort of bizarrely sliced by 0.5% and talked about inflation being somewhat elevated. That was in September, not now.
Yeah,
How much do you trust this Fed, Richard?
Well, I trust the Fed. What I acknowledge, though, and is that a lot of things drive Treasury and mortgage yields and mortgage rates. If you look at the pricing and interest rate futures towards the front end of the curve, they do price in those two rate cuts. But a lot of factors. Secretary Bessent himself says, I want 10-year yields to be lower, and that's going to depend on fiscal policy as well. So I think that's the way that I think about it.
Richard Clarida, former Fed Vice Chairman and also Global Economic Advisor at the aforementioned PIMCO. Richard, we always value and appreciate your time. Thank you very much.
Thank you.
All right, folks, we are just moments away from Jay Powell's press conference. Hopefully get more answers to some of the questions that we just brought up. Steve Leisman has made his way into the room as well. We'll get more reaction to the Fed. Stock markets are higher, bond yields not moving a whole lot, but maybe Jay Powell will change all that. We're going to find out right after this short break.
In a world of uncertainty and disruption, how will your investments stay resilient? We've been navigating change for 125 years, always looking forward, anticipating risks, and trusted to manage over $1 trillion in assets worldwide. Solving for the needs of investors today and tomorrow. That's the power of Nuveen.
As Pacific tensions rise, America's military demands cutting-edge solutions and technology. Meet Air Industries Group, NYSE American AIRI, manufacturer of critical components for what the U.S. Department of Defense considers one of its most vital aircraft programs, the CH-53K King Stallion. With orders in 2024 of over $200 million, supporting both military programs and commercial aviation, backlog is up 41% to over $250 million. Air Industries Group, AIRI.
CIDP is no walk in the park.
That's true.
But I take VivGuard Hytrulo.
Same. It's the first major innovation in CIDP treatment in over 30 years.
VivGuard Hytrulo has been proven to significantly reduce the risk of symptoms getting worse.
And my CIDP can be treated with once-weekly injections that take about 30 to 90 seconds.
Do not use VivGuard Hytrulo if you have a serious allergy to any of its ingredients. Serious allergic reactions like trouble breathing and decrease in blood pressure leading to fainting, and allergic reactions such as rashes, swelling under the skin, shortness of breath, and hives have been reported. The most common side effects are respiratory and urinary tract infections, headache, and injection site reactions. It may increase the risk of infusion-related reactions and infection. Tell your doctor if you have a history of infections or symptoms of an infection.
I'm hitting fairways with the fellas.
I'm hitting the road with my number one. That's how we live vividly with VivGuard Hytrulo.
Visit livevividly.com or talk to your neurologist.
Nothing stands still. Not technology, not the market, and not Franklin Templeton. We've been a firm in motion for over 75 years. Always innovating. Today, We're a leader in public and private markets, digital assets, and custom tax management, empowering advisors with solutions to build the portfolios of the future today. Franklin Templeton, your trusted partner for what's ahead.
Double your investor IQ. Become a smarter investor and save when you bundle CNBC Pro and Jim Cramer's Investing Club. 2 premium investing tools, 1 special price. Go to cnbc.com/access now. Terms and restrictions apply.
All right, welcome back to Power Lunch. We are just about 5 minutes away from the Federal Reserve's press conference. Jay Powell could start earlier, could start later. You never know. Federal Reserve making no change in interest rates, mildly maybe ticking up its inflation forecast, still sees 2 Federal Reserve rate cuts ahead. Here's how markets look ahead of the press conference. I know it's been a rough start to the year, but last couple of days, not terrible. Dow Industrial's up 229 points. It's about half of 1%. Kelly, I think the big story as always is technology. The last few weeks, the story has been technology continues to drop. I know Microsoft has been, but right now the NASDAQ catching a nice bid up 194 or 1.11%.
And we don't often see really positive reactions to the Fed, but we're seeing that so far. Let's bring in Freedom Capital Markets Chief Global Strategist Jay Woods. Jay, the chase is on. I don't want to overplay it, but you think the chair is going to spoil the atmosphere here when he starts to talk, or reinforce it?
He's going to add some volatility to this market. Let's see what he says. You know, the one thing that struck me was the unemployment data. They didn't look at that as changing much. Growth went down. So there are going to be a lot of questions. And, you know, usually the first move is the wrong move, and the press conference gets volatile. Watch the last 30 minutes of the day for the true direction of what this market thinks of his comments.
And that said, bond markets, bond yields, whatever you want to say, started moving. But do you think that's because of what's happening with the balance sheet, or do you think that's just the fact that they said, yeah, core inflation is going to go up a little bit this year, but we would still be cutting rates?
Yeah, I think it has more to do with the latter than the former, but both do play an impact. The bonds didn't move much. Let's see what happens when he starts talking. The bond market has kind of had us scratching our heads for quite some time.
Thank you.
As Brian mentioned earlier, you know, mortgage rates go up when we cut 50 basis points, and people are expecting mortgage rates to come down. So it's going to be an interesting press conference. The dot plot to me was key, that they're still at 2 cuts till the end of the year. When they start, well, maybe we'll get a better idea after he talks.
But just from, and I think you would agree with this, Jay, and I want all of our viewers and listeners, I know there's a lot of people that are kind of newish to the market because the markets have had such a big run the last couple of years. Crypto's brought some people in, maybe some new, by the way, welcome to everybody who may or may not be new out there. The Federal Reserve reserves the right to change its mind based on any data point at any time.
Yep, and you never know what's going to come down the pipe. You know, no one predicted COVID. Look how they had to change to that. I don't want to see them cutting rates because of some unforeseen problem. I want to see them cutting rates for the right reasons, and that would be inflation's under control. The dual mandate has been met. So right now, it seems like things are okay. Yep. And you never know what's going to come down the pipe. You know, no one predicted COVID. Maybe it's a little of a capitulation phase. And then when you look at it over the long term, we had our 3 lowest ratings of sentiment going back to when? 2009. That was a historic low. I don't know if this is a historic low, but when I see readings like that, I'll take the other side of that trade every time. But we do have a lot of volatility coming out of Washington. So one data point at a time. But I think this is a tradable bounce. And let's see if we can get back.
Do you chase,
a little higher than here.
Does tech kind of go back into the leadership here, as we've seen a little bit over the past couple of sessions, or do you have to look elsewhere?
Well, no, I think tech should come back, at least lead from a trading point of view, considering that technology and discretionary, the 2 biggest sectors that usually lead us on these rallies, those Mag 7 names, have been lagging. You get a bounce, it's going to take the market higher with it, because under the surface, it hasn't been the worst market in the world. In fact, Friday and Monday, we had 90% upside days. So to me, that's strength, and usually that will lead us to at least a near-term rally. Let's see what Jay Powell says, and maybe he throws cold water on it. But technically, I think we're set up for a nice little bounce here.
I know today's all about the Fed. We could jump out any time, but Microsoft, what was the step? You know what? Jay Powell's walk.
8-week losing.
Jay, thank you. Jay Powell up right now.
Good afternoon. My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. The economy is strong overall and has made significant progress toward our goals over the past 2 years. Labor market conditions are solid, and inflation has moved closer to our 2% longer run goal, though it remains somewhat elevated. In support of our goals, today the Federal Open Market Committee decided to leave our policy interest rate unchanged. We also made the technical decision to slow the pace of decline in the size of our balance sheet. I'll have more to say about these decisions after briefly reviewing economic developments. Economic activity continued to expand at a solid pace in the fourth quarter of last year, with GDP rising at 2.3%. Recent indications, however, point to a moderation in consumer spending following the rapid growth seen over the second half of 2024. Surveys of households and businesses point to heightened uncertainty about the economic outlook. It remains to be seen how these developments might affect future spending and investment. In our summary of economic projections, the median participant projects GDP to rise 1.7% this year, somewhat lower than projected in December, and to rise a bit below 2% over the next 2 years. In the labor market, conditions remain solid. Payroll job gains averaged 200,000 per month over the past 3 months. The unemployment rate at 4.1% remains low and is held in a narrow range for the past year. The jobs to workers gap has held steady for several months. Wages are growing faster than inflation and at a more sustainable pace than earlier in the pandemic recovery. Overall, a wide set of indicators suggests that conditions in the labor market are broadly in balance. The labor market is not a source of significant inflationary pressures. The median projection for the unemployment rate in the SEP is 4.4% at the end of this year and 4.3% over the next 2 years. Inflation has eased significantly over the past 2 years, but remains somewhat elevated relative to our 2% longer run goal. Estimates based on the Consumer Price Index and other data indicate that total PCE prices rose 2.5% over the 12 months ending in February, and that excluding the volatile food and energy categories, core PCE prices rose 2.8%. Some near-term measures of inflation expectations have recently moved up. We see this in both market and survey-based measures, and survey respondents, both consumers and businesses, are mentioning tariffs as a driving factor. Beyond the next year or so, however, most measures of longer-term expectations remain consistent with our 2% inflation goal. The median projection in the SEP for total PCE inflation is 2.7% this year and 2.2% next year, a little higher than projected in December. In 2027, the median projection is at our 2% objective. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. At today's meeting, the committee decided to maintain the target range for the federal funds rate at 4.25% to 4.5%. Looking ahead, the new administration is in the process of implementing significant policy changes in 4 distinct areas: trade, immigration, fiscal policy, and regulation. It is the net effect of these policy changes that will matter for the economy and for the path of monetary policy. While there have been recent developments in some of these areas, especially trade policy, uncertainty around the changes and their effects on the economic outlook is high. As we parse the incoming information, we're focused on separating the signal from the noise as the outlook evolves. As we say in our statement, in considering the extent and timing of additional adjustments to the target range for the federal funds rate, the committee will assess incoming data, the evolving outlook, and the balance of risks. We do not need to be in a hurry to adjust our policy stance, and we are well positioned to wait for greater clarity. In our SEP, FOMC participants wrote down their individual assessments of an appropriate path for the federal funds rate based on what each participant judges to be the most likely scenario going forward. An admittedly challenging exercise at this time in light of considerable uncertainty. The median participant projects that the appropriate level of the federal funds rate will be 3.9% at the end of this year and 3.4% at the end of next year, unchanged from December. While these individual forecasts are always subject to uncertainty, as I noted, uncertainty today is unusually elevated. And of course, these projections are not a committee plan or a decision. Policy is not on a preset course. As the economy evolves, we will adjust our policy stance in a manner that best promotes our maximum employment and price stability goals. If the economy remains strong and inflation does not continue to move sustainably toward 2%, we can maintain policy restraint for longer. If the labor market were to weaken unexpectedly or inflation were to fall more quickly than anticipated, we can ease policy accordingly. Our current policy stance is well positioned to deal with the risks and uncertainties that we face in pursuing both sides of our dual mandate. At today's meeting, we also decided to slow the pace of decline in our balance sheet. Since we began balance sheet runoff, our securities holdings have declined by more than $2 trillion. While market indicators continue to suggest that the quantity of reserves remains abundant, we have seen some signs of increased tightness in money markets. Beginning in April, the monthly cap on Treasury redemptions will be lowered from $25 billion to $5 billion. Consistent with the committee's intention to hold primarily Treasury securities in the longer run, we are leaving the cap on agency securities unchanged. This action has no implications for our intended stance of monetary policy and should not affect the size of our balance sheet over the medium term. The committee also continued its discussions as part of our 5-year review of our monetary policy framework. At this meeting, we focused on labor market dynamics and our maximum employment goal. As we have indicated, our review will include outreach and public events involving a wide range of parties, including Fed Listens events around the country and a research conference in May. Throughout this process, we will be open to new ideas and critical feedback, and we will take on board lessons of the last 5 years in determining our findings. We intend to wrap up the review by late summer. The Fed has been assigned 2 goals for monetary policy: maximum employment and stable prices. We remain committed to supporting maximum employment, bringing inflation sustainably to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I will look forward to your questions.
Howard Schneider with Reuters. Thanks for your time. So 2 things on sort of the real side here, inflation and then GDP. How much of the higher inflation forecast for this year is due to tariffs? And since the policy path remains the same, are you effectively reading this as a one-time price level shock?
Okay, so how much of it is tariff? So let me say that it is going to be very difficult to have a precise assessment of how much of inflation is coming from tariffs and from other, and that's already the case. You may have seen that goods inflation moved up pretty significantly in the first 2 months of the year. Trying to track that back to actual tariff increases, given what was tariffed and what was not, very, very challenging. So some of it, the answer is clearly some of it. A good part of it is coming from tariffs, but we'll be working, and so will other forecasters, to try to find the best possible way to separate non-tariff inflation from tariff inflation. In terms of your sort of looking through question, too soon to say about that. As I've mentioned, it can be the case that it's appropriate sometimes to look through inflation if it's going to go away quickly without action by us, if it's transitory. And that can be the case in the case of tariff inflation. I think that would depend on the tariff inflation moving through fairly quickly, and it would depend critically as well on inflation expectations being well anchored, longer-term inflation expectations being well anchored.
Well, I guess I'm looking at the out years here, and the fact that the policy path doesn't change at all, and inflation is unchanged in the out years also. Doesn't that imply you all have basically decided that there is no signal here, and that it's just we're back to transitory again?
So I think that's kind of the base case, but as I said, we really can't know that. We're going to have to see how things actually work out. And the fact that there wasn't much change, I think that's partly because you see weaker growth but higher inflation. They kind of offset, and also, frankly, a little bit of inertia when it comes to changing something in this highly uncertain environment. I think there is a level of inertia where you just say, maybe I'll stay where I am.
Thank you. Colby Smith with the New York Times. You just described inflation expectations as well anchored, but has your confidence in that assessment changed at all, given the increase in certain measures and the high degree of uncertainty expressed by businesses, households, and forecasters?
So on inflation expectations, of course, we do monitor inflation expectations very, very carefully, basically every source we can find, and short-term, long-term, households, businesses, forecasters, market-based. And I think the picture broadly is this. You do see increases widely in short-term inflation expectations, and people who fill out surveys and answer questionnaires are pointing to tariffs about that. If you look in the survey world, if you look a little further out, you really don't see much in the way of an increase. Longer-term inflation expectations are mostly well anchored. If you look at the New York, for example, then you have market-based, and it's the same pattern. People in markets are pricing in break-evens. Some higher inflation over the next year must be related to tariffs. We know from the surveys. But if you look out 5 years or the 5-year forward, you'll see that break-evens are either flat or actually slightly down in the case of the longer-term one. So we look at that, and we will be watching all of it very, very carefully. We do not take anything for granted. It's at the very heart of our framework, anchored inflation expectations, but that's what you see right now.
And how much weight do you put on the deterioration in consumer confidence surveys? You said recently that this is perhaps not the best indication of future spending, but I'm curious, what you think is behind this deterioration and to what extent it could be a leading indicator for hard data.
So let's start with the hard data. We do see pretty solid hard data still. So growth looks like it's maybe moderating a bit, consumer spending moderating a bit, but still at a solid pace. Unemployment's 4.1%. Job creation most recently has been at a healthy level. Inflation has started to move up now, we think partly in response to tariffs, and there may be a delay in further progress over the course of this year. So that's the hard data. Overall, it's a solid picture. The survey data, both household and businesses, show significant rise in uncertainty and significant concerns about downside risks. So how do we think about that? And that is the question. As I mentioned the other day, as you pointed out, the relationship between survey data and actual economic activity hasn't been very tight. There have been plenty of times where people are saying very downbeat things about the economy and then going out and buying a new car. But we don't know that will be the case here. We will be watching very carefully for signs of weakness in the real data. Of course we will. But, given where we are, we think our policy's in a good place to react to what comes, and we think that the right thing to do is to wait here for greater clarity about what the economy's doing.
Nick Timmeros, The Wall Street Journal. Chair Powell, Chair Greenspan once defined price stability as an environment in which inflation is so low and stable over time that it doesn't materially enter into the decisions of households and firms.
Can you say that today, that we have that price stability, that households and businesses are ignoring price growth?
When you see buy in advance psychology, big changes in inventories, and surveys that show consumers, at least in the short run, expect higher inflation.
So I do like that definition a lot. In fact, I used it at the recent conference where I spoke. So I think a world where people can make their daily economic decisions in businesses and they're not having to think about the possibility of significantly high inflation. We know inflation will bounce around. That is price stability. I think we were getting closer and closer to that. I wouldn't say we were at that. Inflation was running around 2.5% for some time. I do think with the arrival of the tariff inflation, further progress may be delayed. The SEP doesn't really show further downward progress on inflation this year, and that's really due to the tariffs coming in. So delayed, but if you look at our forecasts, we do see ourselves getting back into the low 2s in 26 and then down to 2 by 27, of course, highly uncertain. So I see progress having been made toward that, and then progress in the future. I think that progress is probably delayed for the time being.
If that's the case, why are there cuts in the SEP for 2025?
So again, people wrote down 2 cuts the last time, and they look at the they wrote down meaningful decline in growth from 2.1 to 1.7 in 2025, a tick up in the unemployment rate, so not much there, but core inflation up by 0.3, and so those kind of balance each other out. So people, not everybody, but on balance, people wrote down similar numbers. The changes aren't that big. The other factor, though, as I mentioned, is just really high uncertainty. What would you write down? I mean, it's really hard to know how this is going to work out. And again, we think our policy is in a good place. We think it's a good place where we can move in the direction where we need to. But in the meantime, it's really appropriate to wait for further clarity. And of course, the costs of doing that, given that the economy is still solid, are very low.
Edward. Thank you, Mr. Chairman. Edward Lawrence with Fox Business. So with near 4% unemployment rate, that should be low enough to bring people in from the sidelines in terms of hiring. But we're seeing the hiring rates have been stuck at 2023, 2024 levels. So what's going on there?
Yeah, so that's a feature that has been for some time a feature of this labor market. You have pretty high participation accounting for aging. You've got wages that are consistent with 2% inflation, assuming that we're going to keep getting relatively high productivity. We've got unemployment, pretty close to its natural level. But the hiring rate is quite low, but so is the layoff rate. So you look at initial claims or layoffs, so you're not seeing people losing their jobs, but you're seeing that people who don't have a job having to wait longer and longer. And, the question is, which way does that break? If we were to see a meaningful increase in layoffs, then that would probably translate fairly quickly into unemployment because people are, it's not a big hiring market. We've been watching that, and it's just not in the data. It hasn't happened. What we've had is a low firing, low hiring situation, and it seems to be in balance now for the last 6, 7, 8 months. That's where we are. There's healthy levels of job creation too. So overall, it's a labor market that's in balance, and we watch it very carefully.
So then, have we seen the new administration's policies in the economic numbers yet? And when do you anticipate that happening?
In labor or in other?
In labor and inflation, just across the economy, have we started to see the new policies take effect in the numbers?
Only in a kind of an early way. I mean, it's only been a few months, right? For example, the layoffs that are happening here are, they're certainly meaningful to the people involved, and they may be meaningful to a particular neighborhood or region or area, but at the national level, they're not significant yet. But we don't know. We don't know how far that will go. We'll find out much more. I mentioned that you saw we've had two very strong goods inflation readings in the last 2 months, which is very unexpected. I think hard to trace it to specific tariffs, but it must have something to do with. It's either noise, and it'll come back, and that's very possible too. But if it is persistent, then it must be to do with people buying ahead of tariffs or raising prices ahead of tariffs and things like that. Those kinds of things happen, and they're very, very hard to capture because so much of it is indirect. A great example is their washing machines were tariffed in the last round of tariffs, and prices went up. But prices also went up on dryers, which were not tariffed. So the manufacturers they just kind of followed the crowd and raised it. So things happen very indirectly. And so there'll be a lot of work done in coming months to try to trace all that through. But ultimately, though, it's too soon to be seeing significant effects in economic data.
Craig.
Craig Torres from Bloomberg News. Thanks, Chair Powell. You said transitory price increases from tariffs are the base case. Transitory is the base case. Wasn't it the base case last time? And didn't the FOMC forecast lower inflation ahead last time? And wasn't the lesson that it quickly got into services, haircuts, daycare, everything else? And so I'm just wondering why the 9 aren't taking that on board and are cutting twice this year.
When you say last time, are you talking about the last?
Pandemic, yes. During the
Because
pandemic.
you could have been talking about the last time there were tariffs. in which case the inflation was transitory. Yeah, no, of course, we're well aware of that. And, it's still the truth. If there's an inflationary impulse that's going to go away on its own, it's not the right policy to tighten policy, because by the time you have your effect, you're in effect, by design, you are lowering economic activity and employment. And if that's not necessary, you don't want to do it. In real time, as we know, it's hard to make that judgment. And we're well aware, of what happened, obviously, with the pandemic inflation. But I mean, we have to look at this as a different situation. There are differences and similarities. I mean, it's a different time. We haven't had real price stability fully reestablished yet, and we have to keep that in mind. And we hear that people are very reluctant to take on to allow prices to go up. At the same time, we hear that businesses are intending to pass many of these prices through. So it's hard to say how this is going to work out.
Steve Leisman, CNBC. Thanks for taking my question, Mr. Chairman. The Bank of Canada, in its last policy statement, said monetary policy cannot offset the impacts of a trade war. What it can and must do is ensure that higher prices do not lead to ongoing inflation. I wonder if that kind of reflects your own sense of prioritization faced with higher prices and weaker growth, that the idea is you have to take care of inflation.
So we have two goals, right? We have maximum employment and price stability, and we have to balance those. And, there can be situations in which they're in tension, right? And we actually have a provision in our consensus statement that says what we should do in that case. That's a very challenging situation for any central bank, and certainly for us. And so what we say that we'll do is we'll look how far each of those two goals is, each of those two measures is from its goal, and then we'll ask how long we think it might take to get back to the goal for each of them, and we'll make a judgment, because our tools work in one direction. We're either tightening or loosening. So it's a very challenging situation. Let me say, we don't have that situation right now. That's not where the economy is at all. It's also not where the forecast is. I don't know any mainstream forecast that really show significant problems like that.
Well, just to follow up, yesterday, the UCLA Anderson forecast said there's high probability of a recession. Where do you stand on whether or not the slowdown you're seeing creates a higher probability or concern that you may have on recession? Thank you.
There's always an unconditional possibility of a recession. It might be broadly in the range of 1 in 4 at any time. If you look back through the years, there could be within 12 months a 1 in 4 chance of a recession. So the question is whether this current situation, those possibilities are elevated. I will say this: we don't make such a forecast. If you look at outside forecasts, forecasters have generally raised, a number of them have raised their possibility of a recession somewhat, but still at relatively moderate levels. Still in the region of the traditional, because they were extremely low. If you go back 2 months, people were saying that the likelihood of a recession was extremely low. So has moved up, but it's not high.
Chris.
Hi, thank you. Chris Rugaber at Associated Press. As you know, I guess last night, President Trump fired 2 members of the Federal Trade Commission, an independent agency, and this could cause the kind of legal fight about the administration's power to fire independent people. If those firings stand, is that a threat to the Fed's independence? Could he do the same thing to the Fed board?
So I think I did answer that question in this very room some time ago, and I no desire to change that answer, and have nothing new for you on that today.
Well, maybe I have another mulligan. As you know, I wanted to go back to the consumer sentiment, particularly the inflation expectations in the University of Michigan survey. In the summer of 2022, you cited the rise in the long-term inflation expectations in that index as the reason that you went big with a 3/4 point hike. So I know you've talked about all the different measures now, but you seem to not be placing the same weight on that. And so I'm just wondering, are you dismissing what we saw last week from the University of Michigan, or does that carry the same weight as it did in the past?
So I mentioned it back then, but in no way did I place a huge weight on it. I think that was a ex post story, but it wasn't the case. That was a preliminary reading, and so is this. And it's also, this is that Michigan, the one you're referring to, the longer-term thing. You know, we look at it, we don't dismiss data that we don't like, we force ourselves to look at it, but it is an outlier compared to market-based and compared to other survey-based assessments of longer-run inflation expectations. So we got to keep that in mind. And I would just say we look at all of them, and that one's kind of an outlier, but you know, nonetheless, we take notice of it.
Thank you.
Michael McKee from Bloomberg Radio and Television. There's a worry on Wall Street that when you say you want to study the net effect of the fiscal policies we may see on the economy, that you would end up waiting too long and be behind the curve in responding to any downturn. How can you reassure people that you can spot a problem early enough unless you decide to be preemptive?
Yeah, look, we're aware of we're well aware of how things are going to evolve and the timeframes and all that. And, you know, we will use our tools to foster achievement of our goals to the best we can. And, of course, we're going to try to be timely with that. For right now, the hard data are pretty solid. We are obviously aware of the soft sentiment data and high uncertainty, and we're watching that carefully, and we think it's a good time for us to wait for further clarity before we consider adjusting our policy stance.
Do you think it's going to be hard to get clarity in a government by tweet? I mean, do you have a feeling that at some point you actually will have a forecast you can trust?
Yes, I think we will. It's hard to say when that will be. You know, these decisions are going to be made, and they're going to be implemented, and then we'll know. At that point, we'll know what the decisions are, and we'll have to make assessments then about the implications for the economy. Those things will happen. A lot of them will happen over the course of, in coming months, certainly over the course of this year, and we'll be adapting as we go.
Rachel.
Hi, Chair Powell. Rachel Siegel from the Washington Post. Thank you for taking our questions. At the beginning, you were talking about separating the signal from the noise and tariff inflation from non-tariff inflation. Can you walk us through what that looked like over the last couple of months, if there were specifics from the January meeting to now that helped you make those distinctions?
So when we say separating the signal from the noise, that's just a way of saying that things are highly uncertain and that, you're reading about developments. The news is full of developments of tariffs being put on and taken off and things like that. Some of that is noise in the sense that it's not really telling you anything. You're trying to extract a signal from that, and the signal is what's going to be the effect on economic activity, on inflation, on employment, and all those things. So that's really when we say signal and noise. Sorry, the second thing was?
Or similarly for tariff inflation, non-tariff inflation, ways that you're making the distinction.
That's sort of a special case of that. The idea being, and I do think that the first 2 months of this year are a great example. You've got high readings for goods inflation after a string of readings that average close to zero, and you have to ask, it's coming during tariffs, but you can't. It's very hard to actually scientifically go back and match up those increases and say, yes, I can prove that that's from tariffs, but it kind of has to be to some extent. Plus noise. There can be idiosyncratic readings in various categories which will shortly reverse, and that happens too, and that could be a big piece of it. I think we'll know. In a couple of months, we'll know whether those were, where that really was from. But that's another case where I think it's going to be very, very challenging to unpack the inflation that we see over the course of this year and be able to say with confidence how much of that came from inflation and how much of it, from tariffs and how much of it didn't. But that's what we'll be doing. We'll be doing that, and so will everybody else, and we'll all be trying very hard to make that assessment. And, I'm sure we will make a lot of progress on that, and we already have. But it's going to be a challenge.
Do you have a sense yet as to what, in your mind, would make something cross from noise to a signal, what that threshold would look like?
It would depend on what we're talking about. I mean, obviously, you're looking for direct evidence that particular pieces of inflation are or are clearly not caused by tariffs. For example, if it's something that was, in the service sector that was far away from anything that's tariffed, you might think, okay, well, that is, like, frankly, housing services inflation. Which, by the way, has been behaving well, which for some time was kind of our problem. Now it's slow, but it's definitely, moving down in a very good way. It's more now with goods and to some extent with non-housing services inflation.
Kelly.
Thanks for taking our questions, Chair Powell. Kelly O'Grady, CBS News. So consumer sentiment has dipped dramatically, but you say the economy and the hard data is still solid. What is your message to consumers that clearly disagree and don't feel that strength? Because the hard data they're looking at is their grocery bill.
Okay, so a couple things. The grocery bill is about past inflation, really. There was inflation in 21, 2, and 3, and prices went up. The current level, it's not the change in prices. It's they're unhappy, and they're not wrong to be unhappy that prices went up quite a bit, and they're paying a lot for those things. So I think that is the fundamental fact, and has been for a long time, a couple of years, why people are unhappy with the economy. It's not that the economy is not growing. It's not that inflation is really high. It's not that unemployment is high. It's none of those things. We have, 4.1% unemployment. We've got 2% growth, and it's a pretty good economy. But people are unhappy because of the price level, and we completely understand and accept that.
And just to follow up, why are you still projecting 2 rate cuts this year if your own projections show inflation higher for longer? Does that mean you see a slowdown in economic growth as a real threat?
So I think remember we came into this with, at the December meeting, the median was 2 cuts, the median was. And so you come in and you see, broadly speaking, weaker growth but higher inflation. And they kind of balance each other out. So you think, and unemployment is really only a 1/10 change. So there's just not a big change in the forecast. There really isn't. Modest, meaningfully higher growth and meaningfully higher inflation, which call for different responses, right? So they cancel each other out, and people just said, okay, I'm going to stay here. But the second factor is it's so highly uncertain. It is just, we're sitting here thinking, and we obviously are in touch with businesses and households all over the country. We have an extraordinary network of contacts that come in through the reserve banks and put in the beige book, and also through contacts at the board. And we get all that, and we do understand that sentiment has fallen off pretty sharply, but economic activity has not yet. And so we're watching carefully. So I would tell people that the economy seems to be healthy. We understand that sentiment is quite negative at this time. And that probably has to do with, turmoil at the beginning of an administration that's making, big changes in areas of policy. And that's probably part of it. I do think the underlying unhappiness people have about the economy, though, is more about the price level.
Victoria.
Hi, Victoria Guido with Politico. I wanted to ask, first of all, if you could clarify. You were talking about how tariffs were a good part of the uptick in the inflation forecast, and I was just wondering what that specifically refers to. Is that the tariffs that have already been put in place? Is that anticipating some of the tariffs that might be coming on April 2nd? And then also, if you wouldn't mind, talking a little more about the balance sheet decision and what drove that. Did that have anything to do with expectations of how the debt ceiling, raising the debt ceiling, might affect the reserve supply?
Yeah. So in the SEP, you'll see that there's not further progress on core inflation this year. We're kind of flatlining, going sideways. We don't ask people to write down how much of this is from tariffs and how much of it is not. But some of it is from tariffs. We know that tariffs are coming in. We know that they're probably already, all forecasters have tariff inflation affecting core PCE inflation, core CPI inflation this year, without exception. I'm not aware of an exception. So it's in there. I can't tell you how much of that it is. In terms of the balance sheet, so yeah, I think, I guess the way I'd say it is, it was the flows in and out of the TGA that got us thinking about it. But as we thought about it, we really came to the view that this was a good time to make the move that we made. And broadly, committee that came around to the view that we would do the same thing we'd already done, which is I guess in June, was it June, whenever it was, we lowered the pace of QT, and we're just going to do that again. We're going to cut it roughly in half. And the sense of that is if you're cutting the pace of QT roughly in half, then the runway is probably doubled. Okay, so it's going to be slower for longer. And people really like that. People thought that's a good idea. You know, it's like a plane. You can think of it like a plane coming in for a landing. As we get closer, and we by the way, we still think that reserves are abundant, although you begin to see some of the things we look at begin to react a little bit, but we still think that they're abundant. And of course, now the TGA is emptying out, so reserves are higher now, so you can't really see the underlying signal. So we came around to the view, and it had a lot of appeal, and so we did it. It has no implications at all for monetary policy. It has no implications at all for the ultimate size of the balance sheet. It isn't sending a signal in any hidden way that you can try to tease out. It's just not there. We're basically, it's very consistent with our plans and our practices that we've published and that we've followed since we began this, what is a very successful rundown of the balance sheet. Again, the second time that we've slowed the pace, and we've said that we would stop when we were somewhat above the level we judge as ample. And clearly we're not at that level yet, but we're going to be approaching it more slowly. It's a common sense kind of a thing, and it had pretty broad appeal, I will say.
Claire. Claire Jones, Financial Times. You said in January, Chair Powell, that inflation expectations remained well anchored. Would you still say they remain well anchored today? And just to reiterate the question others have asked, if they're not so well anchored, why hasn't there been a more radical shift to the policy path today? Thank you.
So when we talk about inflation expectations being well anchored, we're talking about longer run inflation expectations. And they really haven't moved much. I mean, if at all. There's one reading that everyone's focusing on that it's higher, but the other survey readings and the market-based readings all show relatively, well-anchored inflation expectations. You would expect that expectations of inflation over the course of a year would move around because conditions change, and in this case, we have tariffs coming in. We don't know how big, there's so many things we don't know, but we kind of know there are going to be tariffs, and they tend to bring growth down. They tend to bring inflation up in the first instance. So I would say, I'm not dismissing what we're seeing in short-term inflation expectations. We, as I mentioned, follow that very carefully. But when we say expectations are well anchored, we're really looking at longer terms, 5-year and out, and there's really no story to tell 5 years and out, either in market-based or in surveys. But we'll watch it. I mean, we're not we're not going to miss any evidence that longer-term or medium-term inflation expectations are moving.
Neil.
Chair Powell, Neil Irwin with Axios. Treasury Secretary Bessent has observed that a large share of job growth over the last couple of years has been in what he calls government or government-adjacent sectors, healthcare, education. Do you agree that there's some weakness in underlying private job growth, and do you see the composition of job growth as something that has policy implications?
So that has been the case. We talked about that over the course of the last year. There were some good number of months and times when a lot of the job creation was concentrated in, educational institutions, healthcare, state governments, things like that. There were also times when private sector job growth has been moving in a healthy range. I mean, they're all jobs, but and remember, we're at very low unemployment for quite a time now. So I think it's a good labor market, but it's something that we monitor carefully. From our standpoint, employment is employment. But the elected government is entitled to have, we don't have policies that address different kinds of employment, but the elected government has a different role, and they can have those.
Can I do a quick QT question? Does the committee envision at some point tapering the MBS runoff as well?
I think tapering it, I don't know. There's no plan to do that. At a certain point, we'll stop runoff. And we may or may not stop MBS runoff, though, because we want to stop runoff in net at some point. We haven't made any decisions about that. We want the MBS to roll off our balance sheet. We really strongly desire that. So, but we haven't made any decisions about that. I think we'd we'd look carefully at letting that keep going, but hold the overall size of the balance sheet in, constant at some point, a point that we're not out yet.
Simon.
Simon Rabinovich with The Economist. Thank you, Chair Powell. Several times today you've said that you feel you're well positioned to wait for greater clarity. At the same time, you could point to quite a few growth risks at the moment. We've seen a stock market that's gone quite wobbly, rapidly cooling housing sales, plunge in confidence surveys. Today, not only did the S&P mark down the growth outlook, 17 of 19 see risks to the downside. So my question is, how confident are you that you're well positioned, or is that one more thing that you're uncertain about?
I'm confident that we're well positioned in the sense that we're well positioned to move in the direction we'll need to move. I don't know anyone who has a lot of confidence in their forecast. I mean, the point is we are at, we're at a place where we can cut, or we can hold what is clearly a restrictive stance of policy. And that's what I mean. I think that's well positioned. Forecasting right now, forecasting is always very, very hard. And in the current situation, I just think uncertainty is remarkably high.
And sorry, standing here today, would you be surprised to pivot back towards rate cuts in May?
I think we're not going to be in any hurry to move. As I mentioned, I think we're well positioned to wait for further clarity and not in any hurry.
Matt.
Matt Egan with CNN. Thank you, Chair Powell. The Fed statement released today removed a line that previously said the committee judges that the risks to achieving its employment and inflation goals are roughly in balance. Can you explain the decision to remove that line? Does it mean that you're now more concerned about inflation or about employment?
Actually, it does not mean either of those things. Sometimes with language, it lives its useful life, and then we take it off, and that was the case here. There's really not meant to be any signal here. Over the past year, conveying the sense of the balance of risks was important, that they be in balance or close to being in balance. That was useful as we approached liftoff, if you remember. But we're past that. Or sorry, no, beginning to cut. So we just took it out. I actually would say that the more important thing now about risks, and this is in the pages like 10, 11, 12 of the SEP, if you look, participants widely raised their estimate of the risks to of uncertainty, but also of the risks to growth and our employment and inflation mandates. That's a more salient point now than whether they're in balance.
Just on the stock market, the stock market has obviously declined significantly since the Fed last met. Are you concerned at all about some of the market volatility having a real economic impact in terms of hurting business spending or consumer spending, especially among higher income households?
So financial conditions matter to us because, financial conditions are the main channel to the real economy through which our policy has its effects. So they're important. But what matters from a Fed standpoint for the macro economy is material changes to overall financial conditions that are persistent, that last for a while, long enough to actually affect economic activity. So that's what we're looking for. I'm not going to opine on the appropriate level of any market, equity, debt, commodities, or anything like that. And I would just point you to the bigger picture again. The real economy, the hard data, are still in reasonably good shape. It's the soft data, it's the surveys that are showing, significant concerns, downside risks, and those kind of things. We don't dismiss that. We're watching it carefully, but we don't want to get ahead of that. We want to focus on the hard data. If that's going to affect the hard data, we should know it very quickly, and of course we'll understand that. But you don't see that yet.
Jennifer.
Thank you, Chair Powell. Jennifer Schonberger with Yahoo Finance. As you look to navigate higher inflation and lower growth, the Fed has talked about heeding the lessons from the 1970s. Is the Fed willing to have a recession if it means breaking the back of inflation?
Well, fortunately, we're in a situation where we have seen inflation move down from higher levels to pretty close to 2%, while the unemployment rate has remained very consistent with full employment, 4.1%. So we now have inflation coming in from an exogenous source, but the underlying inflationary picture before that was, basically 2.5% inflation, I would say, and 2% growth and 4% unemployment. So that's what we did. That's what together the economy accomplished. So I don't see any reason to think that we're looking at a replay of the 70s or anything like that. Inflation, underlying inflation is still running in the twos, with probably a little bit of a pickup associated with tariffs. So I don't think we're facing, I wouldn't say we're in a situation that's remotely comparable to that.
And last month, the idea of a Doge dividend was proposed, which would send $5,000 checks to every taxpayer from Doge savings. President Trump and Elon Musk have supported this. There's reports there could be a bill introduced on Capitol Hill. What impact might that have on household savings and spending in terms of your growth and outlook for inflation?
It's not appropriate for me to speculate on political ideas or fiscal policy for that matter. So I'm gonna pass on that one. Thank you.
Daniel.
Hi, Chair Powell. Daniel Avis from Agence France-Presse. You mentioned that tariffs are already having at least some impact on inflation. I'm just wondering how you and your colleagues on the FOMC have been thinking about the possibility of retaliatory tariffs from other countries, especially with April the 2nd coming up. Was it something you considered during this meeting? Thanks.
So since the very beginning, we've had kind of a placeholder. The staff has a placeholder of a range of possible outcomes from tariffs and from trade policy generally, and they generally assume full retaliation in those, and so that's kind of baked into the numbers. What happens? It will be complicated, and there will be some retaliation and some not, and all of that. But ultimately, they're trying to, with the placeholder, give us a broad sense of what this might look like. When we actually know the specifics, we'll be able to have still uncertain but better informed forecasts. So yes, that's in there.
Last question goes to Jean.
Hi, Chair Powell. Jean Young with M&I Market News. Had a couple questions on the balance sheet change that you made. So the minutes had initially described your discussion on slowing QT as temporary until the debt ceiling is resolved. But from what you said earlier, it doesn't sound like there's a desire to kind of regain the pace of QT that we have at the moment after the debt ceiling is resolved. Is that the case?
Yeah, so we looked at pausing and we looked at slowing, and really people came together very strongly behind slowing, not pausing, for a variety of reasons. And so people really came to be, pretty strongly in favor of this move. Slows down the path and probably lengthens it, doubles it effectively by slowing by half. That people thought that's a good place to be. It'll help us assure that this path is a smooth one as we get closer and closer to that. So that's how that came about.
Well, I guess my question is more, was that meant to be a temporary measure during the debt ceiling episode, or?
It was the TGA flows, Treasury General Account flows, that got us thinking about this. But the more we thought about it, we came around to this. And it is, yes, it was provoked. The original discussion was provoked by that. But I think what we came up with, though, was broader than that and different than that. It does address that issue, but it really is also, it fits in really nicely with our principles and our plans and the things we've done before and the things we said we would do. So that's why, pretty strong support. I'd just say it's nothing to do with monetary policy, nothing to do with the size of the balance sheet. It's just kind of a common sense adjustment as you get closer and closer. Let's slow down a little bit again. And that way we'll be more and more confident that we're getting where we need to get. You can take our time getting there. We're shrinking the balance sheet every month. And we think it was a good play, and as I mentioned, well supported. Thanks very much.
That was Fed Chair Jerome Powell explaining the Fed's decision to keep interest rates unchanged, also characterizing the outlook as one where policy is in a good place. He acknowledged the uncertainty of policy implications from the Trump administration many times, but conveyed some flexibility in being able to move in response either to sticky inflation or some challenges to growth. Welcome to Closing Bell. I'm Mike Santoli in for Scott Wapner today, live from Post 9 at the New York Stock Exchange. We have a big show coming up with Wharton professor Jeremy Siegel, Charles Schwab's Lizanne Saunders, and Goldman's Jan Hatzius. We'll get their first take on Chair Powell's comments. And joining me on set for the hour is Truist's Keith Lerner. Keith, market found some reassurance in what Powell had to say. For one thing, essentially saying that we really can only consider the net effects of any future policies, but also suggesting a willingness to look through an uptick in inflation and still have that outlook for potentially 2 rate cuts for the remainder of this year. What's your read on how the market took it?
Yeah, well, you're exactly right, Mike. I think he threaded the needle pretty well, and we also had a pretty oversold market. It's not a surprise that they cut the GDP forecast. It's not a surprise that we saw the dot plots, the inflation move up as well. I think maybe somewhat of a surprise is this slowing down of quantitative easing. And when you look at the 10-year tightening, and you're seeing the 10-year Treasury come down, and that's given a boost to the market.
That is true. That certainly helped. It would seem, in the S&P 500, just for context, is right up near yesterday's high, up just under 1.5% at this point. Keith, you're going to stay with me. Let's bring in the Wharton School professor of finance, Jeremy Siegel. Professor Siegel, what's your first read here? There was not a great expectation that there would be bold policy pronouncements here, but there maybe was a little bit of tension in there that maybe Powell could have been more hawkish than he was.
Yeah, most certainly. I mean, I would characterize him as basically optimistic. He said that the real data is still strong. He wasn't alarmed. He said he saw the sentiment drops in the consumer sentiment and some business sentiment, but didn't say that always translates into slower economic activity. But as you said, remains very flexible to move on either side. And I mean, that's sort of an optimal combination. I also think that he was pretty clear that the Fed would not react to the tariffs if they brought about price rises, which he thought would be temporary. And that was something I was definitely looking for. I was wondering, would he go against those tariffs or not? He seemed to imply that he would not go against those tariffs unless it sort of caught on to inflationary expectations or went into some other areas. And I think that the market really probably took some comfort in that statement.
And just to be clear, the dot plot, the summary of economic projections, did imply core PCE inflation going up by the end of this year to 2.8%. It had been 2.5%, and yet collectively the median was still for 2 rate cuts. So there's some tolerance of higher inflation implied there. And in fact, he did say he thought that tariffs perhaps were built into that projection to some degree, although he, as I mentioned earlier, he said, look, the Trump administration's got a lot going on with policy changes in play for immigration, trade, regulation, and of course fiscal spending and taxation, and they're going to have to sum up the net effect of all that before deciding what it means for policy, Professor.
Yeah, and absolutely. I mean, it's a big drop from 2.1 to 1.7. It's the biggest drop that we've had in a 3-month period in Fed forecast for growth since the pandemic. I would have liked to have known how much of that drop was due to the big slowdown, as we know, in the immigration situation, and how much was a drop that he, thought could be due to the uncertainty and dislocations caused by the tariff. He didn't tease that out. Although you also note that the next 2 years also showed a slight drop in real GDP growth. So I was wondering if that is immigration or is that more tariffs? Although the very long-term growth, of course, that I think is 2028, Trump's end of office, that number wasn't changed. But I would have liked to have sort of teased out some of those sources of that real GDP change, because certainly it was substantial.
Yeah, although it's also just kind of tracking, I think, where consensus GDP growth estimates have been going. I mean, the market is backing off just a little bit from the highs. You always have to offer that disclaimer that sometimes the initial reflex move is not the one that lasts. And he really did, of course, and Keith, there was no way he couldn't emphasize the uncertainty inherent in trying to make any projections. He said, I don't know anyone who's highly confident in their forecast, and also said that he didn't know that they would be in a particular hurry to move by May. So, you know, there's something for everyone in here.
Yeah, it's very nuanced. I mean, look at the market today. The advanced decline line's 2-to-1, so that's not rip-roaring, but you are a bit oversold. You're a little bit vulnerable to some good news. But I think ultimately we are seeing some deterioration in the economy. Even though we talked about the hard data versus soft data, economic projections are coming down. If you look at the market as a whole, you know, valuations have reset somewhat, but the key pillar of this bull market has been earnings. So far, those estimates haven't been cut much, but we've seen GDP estimates come down. So I really think we're going to have to see those estimates come down. That's why, even though I think, you know, we are seeing an oversold bounce, which we thought would happen last week or start last week, I think the upside is going to be capped because we are seeing a change in the economic environment, and that's somewhat weaker. But again, a little bit of good news is going a long way the last couple of days.
Yeah, we're up only a few percent off those lows, as you say. Still a lot more to be proven. Keith, Professor, stay with me. Let's send it over to our CNBC senior economics reporter, Steve Leisman, who just stepped out of Chair Powell's news conference. Steve, what really stood out to you?
You know, it's funny, Mike. I actually pulled the quote that you just quoted from the chair, where he said, you know, nobody is confident in their forecast. In fact, let's just listen to it, because I think it really encapsulates where the Fed is at right now.
I'm confident that we're well positioned in the sense that we're well positioned to move in the direction we'll need to move. I don't know anyone who has a lot of confidence in their forecast. I mean, the point is we are at, you know, we're at a place where we can cut, or we can hold what is clearly a restrictive stance of policy.
Now, when I think about why the market's higher, which is, of course, a little confounding, but who knows, right? Maybe is that when he talked about the options, again, it's a repeat of what he said 2 weeks ago at the U.S. Monetary Policy Conference. One is that we could cut if we need to, or we could hold if we need to, but notice no mention of possibly raising rates. And I asked him about that stagflationary quandary that the Bank of Canada addressed, and he says we're not there now, and we'll figure it out when we get there. One other point I want to make, Mike, which is that the Fed chair mentioned pages in the Summary of Economic Projections that none of us ever look at. I just want to say. But page 9, 10, 11, I did look at them when he mentioned it. I should also always look at it, but I didn't this time. And he said, and what he pointed to was the idea that for the majority of participants, the risk to the unemployment rate is higher, the risk to growth is lower, this is the risk to their forecast, and the risk to inflation is higher. And that's where they're at right now, trying to balance all these issues right now, Mike.
Right. And, you know, because he was trying to explain why they eliminated that wording about the balance of risk being roughly equal, and yet sort of pointed to that and saying that things got exacerbated on every side of it. You know, he continues to use the mantra, Steve, that policy's in a good place, and also that, you know, the cost of waiting for further clarity is relatively low because the economy is hanging in there. So, you know, altogether, he's trying to convey the idea that they have the luxury of waiting, whether the market believes so or not.
Yeah, that's right. And I think the key here, Mike, is the idea that this idea that the sentiment data has not spilled over into what we call the hard data. That's really something that is animating Fed policy right now. If that changes, if you do get a spike in inflation, if you do get a spike down in growth, well, then the Fed is going to face the question that I asked him, but they're not there right now. And I guess he has the luxury because these are yet early days in the Trump administration, and for these policies to be working their way through the system. He did say the substantial amount of the increase in inflation is probably from tariffs, but you'll note that it doesn't pass on into 2026 and 27, which is maybe an initial sign that the Fed sees this as at least one-time rise in the price level rather than a broader inflation problem.
Exactly. Steve, thanks so much. And Professor Siegel, one other thing along those lines on the soft data is the chair was not really willing to endorse a close focus on, for example, the University of Michigan inflation expectations, which have really blown out to the upside. Sort of says that survey is suspect. So I guess he didn't use it as an excuse to be more hawkish. I guess the real question is the economy still on a decent path to absorb some friction from tariffs, if that's what's going to happen first, in time, and can the Fed respond in time? I mean, this is always going to be the interplay between expectations and the Fed's ability to be timely.
Right. I mean, he did mention that the market-based long-term inflationary expectations, for instance, those that the difference between the Treasury bond rates and the TIPS rates, which is often used, has really not moved much. So that's, I think, when he was talking about that stability. What did interest me is I don't think one person mentioned April 2nd, which I think is one of the most important dates we have coming up, that hopefully will clarify the whole situation on tariffs, how big they will be or how they'll be negotiated, or some path to how they will be negotiated. I mean, I think that that's going to be very, very important, and it's only 2 weeks away. So hopefully, you know, things will be clarified, and certainly we'll learn from statements by the Fed members after that April 2nd date.
Right. And, you know, before the Fed meets again, which is in early May, we're going to get the April 2nd date. We'll know, presumably, what we're dealing with in terms of tariff levels and breadth and everything like that. We're going to have the start of corporate earnings season. We'll probably have a better picture of what first quarter GDP was. What are your assumptions, Professor Siegel, for whether the fundamental story is going to hold together from between here and now and then?
Well, I think that really does really depend on tariffs. I mean, you know, I've stated on your show that I think, you know, the tariff and the scare of the tariffs and the uncertainty of the tariffs and the on and off of the tariffs has been the, by far, major reason why we've had this 10% correction. If we can get clarity on what it's going to be, and if it isn't going to spark a trade war, although it was interesting that Powell did mention that the trade war retaliation was actually built into some of those forecasts. But if we could be certain that that probability is low, you know, this market could be very much poised for a nice recovery.
Yeah, you know, we are seeing Treasury yields back off pretty substantially on, you know, the collection of what we heard from Chairman Powell, Professor. And I wonder if that seems to be mostly reacting to a modest surprise, perhaps, on the slowing of the shrinking of the balance sheet. Maybe that's going to mean less issuance. It will mean less issuance this year. Or if it's just a conveyed greater flexibility toward easing. I think we are pricing in maybe a little more of a chance of more than 2 cuts this year.
Yeah, I think it's both. I mean, at first, I think it did react to the, you know, slowdown in quantitative tightening, which I don't think is material. And certainly Powell did downplay it. It's not a change in the final policy. But I mean, his statement, you know, clearly is, I think that is as well as the stock market, is that I think the tariff increase prices is going to be a temporary increase, and I do not believe that it would be appropriate for the Fed to react to those temporary increases. Now, we got some pushback from one question of the reporter about, well, didn't you call, you know, the pandemic the temporary increase? And he said this is a very different situation. So holding that position, I think, is encouraging both to the bond and to the stock market.
Right. Yeah, Keith, he had a kind of, I guess, modest defense of transitory as a framework for thinking about how inflation works its way through. And I think it's been a legitimate question as to, you know, is being super vigilant on inflation, if it's coming from tariffs, fighting the last war?
Yeah, no, it's a good point. I actually think the Fed's in a bit of a pickle, right? Because if we didn't have this August 2nd data and we saw some of the data change recently, they probably would have been talking about cutting rates now. That discussion wasn't even in the room for today. Right. So And the longer this goes on with the uncertainty, the longer it challenges businesses. The one thing we talk about uncertainty from a market perspective, we always deal with uncertainty is the market priced for that?
That's right.
After the highs and back in February, we downgraded stocks. We said no. Now we're pricing some of that in. But it's more, I think, more of a balance at this point right now. I don't think there's a big risk-reward call to be made right here.
Gotcha. Professor Siegel, we appreciate your time today. Thank you so much. Let's now turn to Charles Schwab, Chief Investment Strategist, Liz Ann Saunders, who joins us on the phone. Liz Ann, it's great to have you weigh in here.
Thank you.
We've been talking about the interplay between what Powell said, what the market heard, bond yields down, stocks breathing a bit of a sigh of relief. Did anything much change about the investment equation here?
Maybe not in the near term. I was surprised that after Transitory left the Lingo building a couple of years ago that it got let back in. I think that maybe was what the market rallied off of. I thought in terms of the dots, I thought it was the wider distribution that was interesting. You know, you had 8 dots that were for less than the 2 cuts that are still priced in right now. 4 for no cuts, 1 for 1 cut. You also had, and you had 18 of 19 viewing there to be upside risks to core PCE inflation. So I think there's still going to be a lot of digestion of everything that happened today, what Powell said, what was in the dots, in the SEP, and in the statement.
Yeah, and I think the multiple acknowledgments of the inability to settle on how things are going to break with all these policy questions perhaps is the main takeaway. And it's not as if the Fed's pretending it has a handle on how these things are going to go. And, you know, we were just talking here about everyone is sharing these charts of the policy uncertainty index at record highs. And, you know, that both reflects an uncertain moment, but also historically, that's when you kind of want to head to risk assets. I mean, do you think that's actionable at all?
You know what? I think it was Jeremy Siegel with whom you were speaking to just before. I believe it was he who rightly pointed out that there wasn't a mention of what could happen after April 2nd. You know, with the fits and starts of all of these policies that are causing the uncertainty index to go through the roof, particularly the trade policy uncertainty index. We won't really have a sense of what this means, not to mention any additional retaliations. So I think that's the next important date to maybe put a little bit more sort of facts around this stuff right now. At this, we're all at the mercy of how we get the news and trying to judge what that means for short-term inflation.
Sure. The correction in the S&P 500 that, you know, maybe culminated in the short term late last week, you got 10% downside. It obviously was digesting this huge rush out of mega cap stocks. At the same time, we got some kind of an economic growth scare. Where does that leave us, in your view, Liz Ann, in terms of, you know, the valuation, the kind of tactical setup for stocks right here? Did much get accomplished, I guess, with that pullback?
Well, anytime you have a correction, you do ease some of the valuation excess. I guess the rub for some segments of the market, inclusive of the Magnificent Seven, is you've had the numerator going down, but you've also had the denominator going down. Not in negative territory, but a year ago, the Mag 7's earnings growth was more than 50% year over year at a time when the rest of the S&P was low single digits. Now, based on consensus, that Mag 7 earnings growth is going down maybe closer to 20% by the end of the year, where you actually are getting a little bit of acceleration in the rest of the S&P 500. So as I always say, you know, better or worse can often matter more than good or bad, and I think it's the trajectory. But we did see a little bit of easing of those valuation concerns. Now we have to see whether the setup, given that estimates have come down for 2025 broadly for the market, but even those names, whether yet again the bar has been set too low and we have a first quarter reporting season akin to what we had for fourth quarter, which was too low a bar, 9.5% expected at the start of the season, 17% is what we ultimately got. I think that's the next important test for the market beyond this tariff stuff, is once we start getting earnings reports and what the outlook is for companies, especially with regard to profit margins.
Yeah, definitely too low a bar in terms of consensus going into the reporting season. But I guess in terms of the market, it wasn't able to really gather a whole lot of sustainable strength from that high beat rate. So I guess that's going to be the question heading into this quarter, too. You still favor, Lizanne, sort of lower volatility and higher quality that still makes sense to you?
Yes, I think you're going to get rally days like we've seen in the last few days where you see some money come in and look to bottom fish in some of the hardest hit names. And then you see a reversal on those days into the higher beta, higher volatility names. But I think still sticking with that broader quality wrapper, low volatility being a component in a broader sense than just from a trading perspective does still make sense, yes.
Yeah. And then, I guess the other piece of it that he didn't get into too much detail, but the idea that we're doing fiscal restraint or at least gestures in that direction at the same time that these tariffs might go up, it's sort of fouling up everybody's GDP number, or at least it's putting pressure on that. Do you think that is going to drive waves of downside in that forward estimate as we go from here for earnings?
It's in terms of the connectivity to earnings, it really is the profit margin story. And I think one of the problems with fourth quarter reporting season, which just finished a few weeks ago, is not so much that there was direct downward guidance. It was just the uncertainty factor. And when left with that limited guidance, I think analysts erred on the side of lowering numbers. They certainly didn't extrapolate the stronger than expected number for fourth quarter into this year. And if consensus is right overall for the S&P, you're looking at a growth rate expected in 2025 that, though still double-digit positive, is lower than what the growth rate was in 2024. Therein lies the, better or worse can matter more than good or bad. So it could be a make or break quarter in terms of the outlook, not just for the first quarter, but what the trajectory looks like into year end.
Yeah, for sure. When you typically have some back end loaded forecasts. Lizanne, great to have you weigh in today after this Fed meeting. Appreciate
Thanks,
it.
Mike.
All right. So Keith, the S&P 500 is still holding this 1.4% gain. It's about 0.5% off the highs right here. What are you viewing as sort of the next key catalysts or signposts we're looking for here?
Well, I think it is economic data. I mean, I think the market has really focused more on the health of the economy from inflation. And that's what the 10-year is telling you as well. You've had a nice, if you think about last week, you had the capitulation with the spike in put-to-call ratios. You had the back-to-back 90% up days. Historically, that's a positive. So far, you're seeing a good reaction to today's news. So I ultimately think this market is going to move a little bit from fear to greed. But then as we move up to, say, 5,800 to 6,000 on the S&P, I just think you're going to be capped somewhat because during this period of uncertainty and when we go into the quarterly earnings season, I don't think you're going to see a lot of upside guidance going forward. So I just think we're going to be in a choppier range, and you're going to look for some tactical opportunities. But right now, you're maybe towards the lower end of that range. And, if you're a trader, you're going to trade there. If you're a longer-term investor, you buy towards the bottom side. And if you get towards the top end of the range, we're telling our clients dial back risk a little bit.
Right. Yeah. So those all-time highs are like around 6150-ish.
I think it's going to be a challenge to break through that in the near term.
All right, Keith, we'll get back to you in a little bit. A quick programming note. Scott Wapner is back tomorrow, and we'll bring you an exclusive interview with Double Line's Jeffrey Gundlach right here on Closing Bell. We'll get his first take on Chair Powell's comments at 3 p.m. Eastern Time. And up next, Goldman Sachs' Jan Hansius is here with his first reaction to the Fed decision. That and much more when we take you inside the market zone.
New projects means new project managers. You need to hire.
I need Indeed.
Indeed you do. When you sponsor a job on Indeed, it's easier for talented candidates to find it, which makes it easier for you to hire them. Visit Indeed.com/hire.
It's a smart move to get a second opinion. You do it when you're looking for a contractor. You definitely do it with medical advice. So why not with your stock market investments? We can help you see opportunities you may be missing. At Henyon & Walsh, it only takes a second to schedule your free second opinion. So what's there to lose? Speak to Henyon & Walsh, the second opinion people.
Hi, I'm Tony Hawk, and like many of you, I take a statin to reduce cholesterol. But statins can also deplete CoQ10 levels. That's why my doctor recommended Qunol CoQ10. Qunol has the #1 cardiologist-recommended form of CoQ10. Qunol, the brand I trust.
Welcome to CNBC's Crypto World.
CNBC's daily digital show has trading updates, the latest headlines, a global perspective, and high-profile interviews. Scan to watch CNBC's Crypto World, sponsored by Crypto.com.
I find it challenging to come up with a gift that's really impactful, something that really makes a difference. Jolie has been a tremendous gift. It's something that is not only looks beautiful, but makes us feel amazing, and is something that we get to use every day.
You don't have to be a prepper to protect you or the ones you love. Introducing the new Patriot Power Generator 1200, a solar generator that's lighter, more affordable, and more powerful. In a blackout, power lights, TVs, medical equipment, even your fridge. No gas, fumes, or noise. It's safe to use inside your home. You'll even get a solar panel absolutely free. This is about your peace of mind. Get your new solar generator and free solar panel at forpatriots.com.
At Baird, we have investor relationships in 35 countries and market expertise in over 40 industry verticals, all to help make the most important investment connections of all, yours. Discover the Baird difference at BairdDifference.com.
Custom Ink helps us motivate our students with custom gear. We love how Custom Ink takes care of everything we need so we can focus on the kids.
We make it easy to wow all your groups with high-quality custom apparel, accessories, and promo products, all backed by our guarantee at CustomInk.com.
Well, would you look at that?
Jerry, you gotta see this.
Saying it. Trust me, after 15 walks, gets a little old. Yeah, I really should be retired by now. Wish I invested when I had the chance. To the moon. Unbelievable.
Stop waiting. Start investing. E-Trade from Morgan Stanley.
The Market Zone is sponsored by E-Trade for Morgan Stanley. Trade commission-free today with no account minimums.
We are now in the Closing Bell Market Zone. Tourist Wealth Co-Chief Investment Officer Keith Lerner is back to break down these crucial moments of the trading day. Plus, Courtney Reagan on the moves we're seeing in some of the retail names. And Goldman Sachs' Chief Economist Jan Hatzius joins us for his reaction to the big Fed decision. Jan, going to start with you. I mean, you were looking for the summary of economic projections to lift the year-end core PCE forecast to 2.8%. That's what happened. They did downgrade GDP growth, but kept the 2 rate cut median expectations. So all of that pretty much in the zone. What you thought? What did you hear from Powell in the press conference?
Overall, I thought this meeting was generally in the zone. I think at the margin, he was probably a bit more dismissive of the increase in inflation expectations that we've seen, especially in the University of Michigan survey, but also in a couple of the other surveys, Atlanta Fed Business Inflation Expectations Conference Board. So not to the same degree as Michigan, but I think there has been some increase, and we don't know how that evolves as tariffs actually come into force. But I thought he was a bit more, he was downplaying it a bit more than I thought.
And so the takeaway from that, of course, is that he's a bit more concerned about risk on the growth side, or at least would be tolerant of higher inflation in a context of potentially nudging rates lower.
I think that the meeting was, when you take it all together, just a touch more dovish for those reasons. There's also the additional taper on QT. That's not a monetary policy tool. They're very, focused on the idea that it's really rates, but nevertheless, it's also taken that way.
And so, I mean, he didn't profess, any greater vision of exactly how things are going to unfold than any of us have. But he's saying, there's these 4 policy forces, Trump administration on fiscal, immigration, trade, deregulation, and the Fed will have to assess the net effects of these things and how it bears on the economy and policy. It seems like that would take a long time to get a handle on all those things. So what do you think the next kind of 100 feet of road for the Fed is at this point ahead of it?
Well, I think It will take a while. Now, of course, we've got April 2nd. We've got the announcement. We'll see what happens in terms of tariffs, how they calculate the reciprocal tariffs in particular, because there's a big bid ask on what you can do if you just look at tariffs that our trading partners impose on us and compare that with U.S. tariffs. That difference is very small. But if you say VAT is also tariff-like, that would imply a very big increase. So we'll learn quite a lot over the next month. But you're right. If you take all the other aspects of policy, that's going to take a long time, especially because fiscal policy is on a much slower path. And so that would suggest, it can still take a while before they actually get to cuts.
When asked directly about the prospect of a May rate cut, he tried to downplay that, right? He said, I don't know that we'd be in any hurry to make any moves. How does that jive with what you're expecting the Fed to ultimately do?
Yeah, I mean, May, I think, is highly unlikely. We have 2 cuts in the rest of the year, similar to the Fed. We've got a June cut and December. I think June is at risk of being delayed. And I certainly think, despite the slightly more dovish tone, it doesn't sound like they're super close.
And in terms of, I know you've recently kind of curtailed your GDP forecast for this year. Does it seem as if the market, the economy has either the momentum coming in or solid consumer balance sheets? You have these offsets to whatever pressure points we're getting, that it seems like it can fight its way through this period okay?
Well, I think there is a lot to like in terms of the U.S. economy, right? The productivity numbers have been great. We're still getting a tailwind from post-COVID normalization. Wages have been growing a lot more quickly than prices. So we're coming into this period of policy uncertainty in a good spot. We're going to have to see how much of a drag we're going to get from especially the tariffs. We're in a similar place as the Fed. Our Q4 to Q4 growth forecast is 1.7%. And I do think there's going to be a slowdown, but we're going to have to see how substantial it's going to be. And that probably is going to take a little bit of time.
And I know you've done a lot of work on the immigration piece here, which perhaps is a little bit more of an immediate impact if you look at a lot of the real-time data. What does that mean? Because it would seem as if it might help put a lid on the unemployment rate. At the same time, it could curtail payroll growth.
Yeah, I mean, it's
lower.
Also going to be a drag on growth from both the demand side and the supply side. It's going to be smaller. I mean, we don't think that the impact of that is going to be all that large. Certainly, if you compare the pace of immigration with what we saw pre-pandemic. Of course, if you compare it with 2023, that's a huge change. But 2023 was such a big outlier that you really ought to be comparing it with pre-pandemic. And there, it's not that big a difference. So I am mostly focused on the tariffs. That's where the uncertainty is greatest, and I think that's what's going to have the biggest impact.
Sure. You did mention the balance sheet move. I mean, I guess maybe there was a little bit of surprise in there on the dovish side. Rates have reacted to that. I mean, what levels would you be looking in terms of, let's say, 10-year Treasury yields to indicate that you could actually have them either become stimulative or help housing?
I always look mostly at broader financial conditions, not just the 10-year yield. But we've been running in a low to mid fours kind of environment for 10-year yields. So if we were to go back below 4%, I think that would be more stimulative.
And general financial conditions at this point, you feel as if they're okay, they're relatively in decent shape?
Well, we've gone from having a fairly meaningful positive impulse from financial conditions late last year on the order of 0.5 percentage point to growth, maybe 3/4, to a mild negative impulse because of the recent sell-off in the stock market and tightening in financial conditions. But nothing dramatic so far.
Sure.
Call it a 0.25 percentage point.
Got it. Jan, great to have your views here. Thank you very much.
Thank you.
All right. Courtney, a lot of retail names going their own way today. Tell us about it.
Yeah, absolutely, Mike. I mean, the major retail-related ETFs, those are largely higher today, but also outperforming the broader indices because of some of those travel-related names, at least in the consumer discretionary ETF, rather than sort of pure retail itself. But there are some other retail movers that I want to talk to you about. So let's talk about Signet Jewelers. That's up really big here today, about 17%. After reporting, let's call it better than feared quarterly results, because they gave us a preview in January. Mixed guidance, though, but Q1 above consensus, full year lighter. Still looks like the street giving them the benefit of the doubt. This is the parent of Jared, Zales, Blue Nile, and others. And they're noting that all categories saw growth. New CEO JD Symantec outlined a new strategy. Even in an uncertain consumer backdrop, it seems like the street likes it. Now, we've got closeout retailer Ollie's Bargain Outlet. That put up a mixed quarter and mixed guidance. A new stock buyback program. Jefferies does say there's a lot to like here, including liquidation of competitor Big Lots, which is good news here for Ollie's. But Jefferies believes the valuation does sort of account for some of that already. Still shares up 9%. Not all rosy in retail, to your point, Mike. Williams-Sonoma shares, those are lower with light earnings and margin outlook, and that's overshadowing the fourth quarter's positive comp sales that it saw really across all of its brands. Those shares down about 3%. And then we'll get another read on the consumer when Five Below reports after the bell today. So that's coming up.
Court, it's hard to quantify these things, of course, but retail has been a sector that's been so focused on the prospect of heavier tariffs. And I know it's sort of a very complex interplay with how these companies operate. It seems like today, in general, there's a little bit of relief on the areas of retail that have been most pressured.
Yeah, absolutely. I think that that's very true. I think there's a lot of homework that needs to be done, to your point, when it comes to the tariff impact on each of these individual players, because obviously their sourcing is going to vary wildly, whether it's Canadian or from Mexico or Canada, Mexico, China, or maybe none of the above. And I think some of the street is doing a little bit better job today parsing out which is going to be impacted, which isn't, what they feel relief about and what's not. I think the Signet action is actually pretty interesting because by and large, there's a lot of work to do at that company. And the CEO admitted it to me on the phone here this morning as well. That being said, it was better than what was feared. And so the street may be giving some benefit is out there. Well, Williams-Sonoma has had some strength for some time. And so they're not continuing that forward momentum into the first quarter from the fourth. And the street kind of disappointed about that a little bit. So maybe some pressure away from that overarching tariff story on retail, at least today.
Yeah, well, and you mentioned travel as well, which had been really pressured pretty heavily coming into this period. Court, thank you very much.
Thanks, Mike.
As we head into the close, still holding on to about a 1% gain here. Keith, what do you make of the kind of violent rotations that have been happening within the stock market here? Really, outside of the Mag 7, market's kind of flat year to date, even though it's down maybe 4% or so overall in the S&P 500. Does that continue, or is that primed for a snapback?
Well, I think part of what you're seeing is that money going from that Mag 7s going to everything else. That's why it's relatively flat. I think tech is getting a little bit oversold on a short-term basis, so probably some rotation back. But I was listening to Jan's view as well. Think about what he just said. GDP estimates coming down. He's saying that the Fed may have to be delayed even further, and you have some fiscal tightening. Not an environment to us as far as new highs. Now, the one thing I think we have to keep an open mind, after the election, we were all focused on all the positives. Now we're focused on all the negatives. The question becomes, when do we start focusing on deregulation, tax cuts, and maybe the Fed cutting rates? But in the interim, I just think we have this pretty choppy period where the risk-reward is just mixed. And I hate to say it, being somewhat neutral here makes sense. And I think there will be better opportunities later this year to be more aggressive.
It's almost as if to be more aggressively bullish in the near term, you'd probably be making the bet that they're going to really pull the punch on tariffs. Because that is within the administration's power, but it doesn't seem like that's where they're headed.
It is, but we also have to think those tariffs are, some countries are going to be hit with tariffs. And I think we're going to continue to see other issues come up where those tariffs slow down part of the global economy. So, yes, we can have a short-term pop because of that, but ultimately, I think the story is going to be, does this economy once again prove resilient like it did coming out of the pandemic, like it did when the Fed had the fastest rate hiking cycle since the 80s, and how it did as we dealt with this high inflation? Because we've been proven over and over again that this economy has been more resilient. So it's an open question at this point.
Right, a heavily services-based economy that mostly just sells to itself and usually can hang in there. Speaking of that, though, the major rotation this year has probably been to non-U.S.
Yeah.
And, it's been so long in coming. Is it the kind of thing where it's just a trade, or is it a new trend?
I think it has likely longer to go. You know, if you think about coming into this year, the market's all about our expectations. U.S. expectations were up here, international expectations down here, and a little bit of good news has gone a long way for international. It's actually following the playbook following 2016 where you had that outperformance, and I think that fiscal change is somewhat different. So we are still overweight the U.S., but we have brought in that bet and raised international somewhat just to offset that. We think it's going to be a more even playing field, at least in the near term.
You know, you could even look at, I know the popular trade was equal weight, get away from the mega caps coming into this year, and equal weight valuations are kind of long-term average. They're not compelling, but they're not excessive. And yet the process of getting that rotation in place seems like it means more choppiness and more volatility.
Well, also, when you look at the equal weight or the value, a lot of times what you need to see is an accelerating economy. For something, there's something about relative performance versus absolute. And yes, the RSP and the equal weight is holding up fine on a relative basis, but it's not blowing the doors out either. So I think you actually, for that trade to actually have a lot of upside, you need to go through that peak uncertainty phase and see the economy reaccelerate. Now, the market will sniff that out ahead of time. I just don't think we're there yet.
Right. Yeah. No, the market is going to try to get ahead of it. Often overshoots. Maybe we saw that recently. Keith, hey, great having you here. Thanks
great to be here. Thank you
for spending the hours. We head into the close. The S&P 500 has been losing a little bit of altitude in the last little bit. Still up more than 1%. It's on pace to close below yesterday's high, though. Pretty significant move within the bond market, though. Yields did come off a fair bit. 10-year yields below 4.25 in response to what was taken as a net dovish tone by the Fed. The volatility index also easing back, though far from super calm levels. It did tick below 20 briefly for a little while there before popping right up around that level. And we do have pretty good breadth on the market today. About 70% of all volume on the New York Stock Exchange is to the upside, to the average stock is hanging in there. That does it for Closing Bell. We'll turn it into overtime with Morgan Brennan and John Ford.
That's the end of regulation. Black women on boards ringing the closing bell at the New York Stock Exchange. Niagen Bioscience doing the honors at the NASDAQ. Well, that's the scorecard on Wall Street. The action's just getting started, though. Welcome to Closing Bell Overtime. I'm Morgan Brennan. We've got stocks storming higher into the close after the Fed kept its forecast for 2 rate cuts this year while noting increased uncertainty about the economy. The S&P finishing up more than 1%. But coming up, we will get a reaction to the Fed's decision and what it means for your portfolio from Dan Niles, David Zervos, and Sarah Malik. And if you're wondering where John Ford is, well, you'll see him in just a few minutes when he speaks exclusively with Adobe Chairman and CEO Shantanu Narayan from the Adobe Summit in Las Vegas. And later, Continental Resources Chairman and founder Harold Hamm will be discussing the outlook for oil prices right now at the White House with President Trump. He's going to join us once that meeting wraps up. But let's bring in BD8 Capital Partners CEO Barbara Duran and Jefferies chief market strategist and CNBC contributor David Zervos, also CNBC's senior economics reporter Steve Leisman. As we do wrap up this Fed day, Steve, I'm going to go to you. You're in the room. There were a lot of expected moves and comments by Powell, specifically the fact that rates were kept unchanged. Talked about uncertainty. Looks like the economic projections were weakened here. Inflation possibilities strengthened. To me, one of the biggest takeaways was the fact that QT is going to get less tight here in the next couple weeks.
I think that's a factor here, Morgan, but I'm going to give you my movie review here rather than the technical analysis of the Fed. I personally think the Fed is in a very difficult position here, and I think Powell made it clear how uncertain it is, but I thought Powell was very confident in his options and what he can do. He doesn't seem to be panicking here. And I thought in terms of how the market reacted, I thought his demeanor was a big part of that. He was not fumbling for answers. He really seemed to have thought all this through. I asked him the question about really the stagflation idea, which is if you're in this situation of higher inflation and lower growth, what do? He seems to really have thought that through. And there isn't much the Fed can be doing here. The Fed is very uncertain about the outlook. So, and you could see that in all of the projections. So I think right now everybody's in a holding pattern. I wouldn't be betting the farm on any outcomes here, but in any event, I think that the Fed feels pretty confident about where it is in its ability to deal with situations that are very unclear.
David, one of the things that stood out to me was Powell's comments on the fact that it appears that consumer spending is slowing, because you juxtapose that to Brian Moynihan of Bank of America, who was on CNBC earlier today, and here's what Moynihan had to say. Have a listen.
Our Bank of America consumers are putting 6% more money, into the economy than they did for the first 2.5 months of last year, and that's a pickup from the fourth quarter last year, which ran 4.5%. So that money is going to different places, and you've referenced some clients who might be seeing different things, but a lot on services, a lot in entertainment, but the spending levels continue to go up.
Your takeaway, David, on what we heard from Powell and what we've seen in the macro data thus far, which admittedly has been more of the softer data where we've seen weakening, and what we just heard from Brian Moynihan earlier today, which I would imagine is tied to more high-frequency data, given the fact that the bank has its hands on so many different aspects of money as it's moving through the system here.
Well, Morgan, I think it actually, there's a sort of broader issue here, and I think Jay really highlighted it when he was asked about the confidence surveys and some of the weakness that we've seen in those confidence surveys. He said, look, these surveys have really not been helpful for over a couple years now. They were very negative, but people still went, I think he said people were negative in their survey and they still went out and bought a car. So I think he's really downplaying the importance of survey data and highlighting more the market-based data, like what he did with inflation expectations. And I think when he gets asked about the consumer sentiment or business sentiment surveys that seem to show some cracking and weakness, he's not taking that nearly as seriously as he might have before, because they really misguided the street and all of their calls for recessions 2 or 2.5 years ago. So I thought that was the interesting part of how Jay responded to those consumer sentiment indicators. And what you're seeing from Moynihan is not inconsistent with kind of what Jay said about the real data, which is the economy sits in an okay place. We've got a low unemployment rate. We've had inflation that's come down. It's a little sticky above target. But yes, there's some signs that things could get bumpy, but there's always signs things could get bumpy. There's, as I think Jay said it, there's always sort of a 20% probability or so that we're going to go into recession for whatever reason. So you always want to be nervous about it, but he has the tools, as Steve said, to fight it. He feels very confident. I think the market liked hearing that kind of Fed put style language and went up. And I think the QT, as you opened up your statement with, had a lot to do with the immediate market reaction today.
Barbara Duran, want to get your thoughts on this, especially given the fact that major averages were higher today, but definitely moved to another level during that Powell presser. And yes, we gave back a little bit of the gains here into the close, but as I mentioned before, the S&P is still up more than 1%, the NASDAQ up 1.4%. Did those moves, did that market reaction surprise you?
Not given what Powell said, because what I found most interesting, Steve is right about he kept saying it's uncertain, and certainly about the sentiment indicators, David is right there. And I think Powell is at pains to say those are short-term indicators. We have not seen long-term inflation expectations, for instance. So the consumer and business surveys may reflect the emotion of the moment and all the headlines. But what was interesting is that even though they raised the unemployment rate prediction for this year, they raised inflation, they cut GDP growth, they still are talking about 2 cuts. So to me, that says they're not certain, but it looks like this is a lot of short-term noise, because given the underlying fundamentals that we've all talked about and seeing what's happening with jobs and consumer balance sheets, it seems like this could be a stutter step as people wait to get certainty on the tariffs. And certainly at this point, the market seems to me very oversold. It has swiftly discounted worst-case scenarios. So I think there's some interesting picks in here.
Steve, I want to get your thought on the fact that the dot plot is signaling 2 rate cuts this year, which the market was largely expecting, at least here in recent days, ahead of this meeting. What do you think it takes to see those cuts realized?
Well, first of all, I think it's worth pointing out, Morgan, that the dot plot is a little more hawkish. Your most dovish people came up towards the center or towards the median. You had some people come up and say, 4 people, I believe, are forecasting no rate cuts this year. It's still a median because there's a chunky 9 members right there in that 2 cuts. So they are a little more cautious. And then you can see here the market essentially had some concerns about those rate cuts this year, and now it's a little bit more confident looking at before Powell spoke and afterwards. But Morgan, one idea I have is that it's very interesting, and one of the things that might be giving the market some comfort here is Powell's clear forecast that the Fed will not be acting preemptively in any way, and that tariffs have two chances to not be an issue. The first is we're not going to act preemptively. And second is even if there is an impulse from tariffs into the indices or into the inflation indices, that we're not going to even act necessarily on that because we want to make sure that there's some kind of permanent or the idea of them bleeding out from tariffed into non-tariff goods. And that, I think, is reasonably reassuring to the markets here. And then that leaves you the other side of the mandate where Powell may be more likely to move if it's clear sign that there's weakening on the unemployment side. So I think the mandate and the idea of the market thinking about where does the Fed defaulting to, I think they're still defaulting to cuts here if they can get away with it.
David, the fact that trade policy and tariffs specifically tend to be something the executive branch enjoys largely unilateral control over. They don't have to bring lawmakers on board to get a lot of that policy enacted. It's obviously getting the most attention. It's obviously taking the most oxygen out of the room. But how much is this just a first step in a broader multi-step strategy that is going to involve deregulation and tax policy changes and other things that will require lawmakers and others to come to the table?
Well, Morgan, I also think it'll require lawmakers to come to the table for sure. But it also, I think Jay was very specific about how he wants to take a holistic approach to the policy changes, all four of them: fiscal, monetary, immigration, deregulation. All of those are going to go in the mix. He's not just hammering on tariffs, and we hear tariff, tariff, tariff. We often don't hear a lot about government efficiency and deregulation, which have some pretty positive supply side effects on business. So I think that was another reinforcement. And overall, Morgan, I just would like to say, I think one of the things the market might have been afraid of going into this a little bit, why we got a pretty nice reaction both in stocks and bonds, is that they were a little worried that Jay might be confrontational with the president, that we might, start to see the tweets fly again or the X posts, whatever you want to call them. And my bet is you're not going to get an X post out of the president after this meeting. I think the QT move was a little bit of a nod to the administration, a little bit of a, hey, we're not going to get in the way here. And that's a positive for the market. The market doesn't want to see the Fed and the executive branch having a bit of a tussle like they did back in 2018. So I think there's a bit of a sigh of relief on that.
I want to point out that Zervos just guaranteed there's going to be a tweet now. Thanks a lot, Dave.
We'll be watching for it. We'll be watching for it. In the meantime,
let's see.
In the meantime,
good luck, Dave. Good work, David.
In the meantime, Barb, I do want to get your thoughts on the other sort of big market story of the last, call it, couple of days, and that has been the stabilization we've seen in the Mag 7 stocks after a big downdraft there too. Are there buying opportunities there, or perhaps in other parts of the market now?
Right. Yeah, they are. I mean, I own all of these names except for Tesla. And if you saw last year, we often saw these opportunities arise where, when the stocks have run up so much, particularly this group, they are the source of profit taking when you want to rotate into other areas. And certainly I think that is a big part of what has happened the first start of the year. I mean, they were very highly valued when we came into the year, and when things start to go south, you take the money and run. And I think that's what's happened here. So a lot of these names, whether it's Amazon or Meta, which have great long-term pathways of growth forward, very visible, very strong, with lots of opportunity for new growth in different areas, I think there are great buying opportunities down here. Some of these we have not seen these prices and this valuation for quite some time. Even an Alphabet, which does have some hair on that stock in terms of regulation, antitrust issues, is under 20 PE, and yet their growth is pretty strong. So I think there's a lot of opportunity to be putting cash to work, and I have been, frankly.
All right, Barbara Duran, David Zervos, and our own Steve Leisman. Great to kick off the hour with you all. Thanks for joining me.
Thank you.
Well,
Thanks,
Five
Morgan.
Below earnings are out, and Courtney Reagan has